Hi, I'm Max Keiser, and welcome to the Keiser Report. You know, money printing by the central banks is causing a lot of trouble. Stacy Herbert.
Yes, Max, it's causing revolutions all over the world. But you might ask, when's it going to hit America? Other than these union protests happening in Madison, Wisconsin, what's going on in the U.S.? Well, let's talk about this first headline here. 18 sobering facts which prove that the middle class is not being included in this economic recovery. And I'm just going to go over some of them.
Yeah, let's hear a few of these.
You mentioned money printing. Of course, that causes inflation. And we see that in his point number 5. Gasoline prices in the United States recently hit a 28-month high. And you often talk about the fact that, in fact, gasoline prices is the most crucial of all. So in Egypt and Tunisia, wheat prices are very important because a large part of the average person's budget goes to food, and this includes eating wheat-based products. In China, it's rice. In Asia, it's rice. In the United States, it's gasoline, because essentially Americans live in their car, they drive from suburbs and exurbs into whatever job they might have, and they eat basically gasoline and all of their manufactured products.
Yeah, that's right. Gasoline is really the only point at which the average U.S. consumer makes contact with the economy and the global economy. And for this reason, it's been kept artificially low for years as the basis for America's foreign policy is to invade a country, steal their gas, and keep the people driving to Walmart.
Another one, number 8, almost 14% of all credit card accounts in the United States are currently 90 days or more delinquent.
Right. Well, this is a huge and growing scandal because the banks, in order to feed the monster of their credit card business, they keep offering more cards with more onerous rates. And it's a huge Ponzi scheme. This is just another one of the Ponzi schemes within the huge global and American Ponzi scheme that is collapsing Bernie Madoff style.
If we're comparing the U.S. to the rest of the world and the Middle East, which is on fire now, you have military dictatorships there. In the United States, we have financial dictatorship there. So in that headline, in this fact, you see a sort of predatory behavior towards the population. If 14% of the population is even unable to pay the credit cards, then what are you doing extending credit to them?
Well, I think that's correct to use the phrase financial dictatorship, and it's a kind of a velvet dictatorship in that you believe that you're willfully just racking up huge debts on your credit card, but then when you scratch the surface and you see that it's tied to, let's say, a food stamp industry that's financed by the likes of JP Morgan to provide credit to go into debt to buy basic food that's being risen in price by manipulation on the futures markets by the same JP Morgan, you understand that it's a dictator who's really eviscerating, to use your word, or to disenfranchise the average person in a way that it's hard for them to notice. It's not about a gun to their head. It's about just quietly bankrupting them.
Let's go to point number 10. Americans now owe more than $890 billion on student loans, which is even more than they owe on credit cards. So here is this real attack on the young generation, which is what you see going on in the Middle East. These are the young rising up against the middle-aged and older people who control this, the military oligarchies there. In the United States, we have these financial oligarchies, and the youth are the ones that have been bludgeoned more than any other.
Well, it's sad, really, because that's your research and development cost or expense. The government should not force their youth into indentured servitude to pay off university and college loans that once again go to intermediaries like Sallie Mae and other so-called quasi-government sponsored entities to make bankers rich again. The government should want to increase educational standards, increase the brain trust of America so that America can compete. But by making students into debt slaves, all you're doing is making bankers rich. These people can't compete on the global stage anymore. And it's an extraordinarily short-term view of how to run an economy. Obama, I mean, where is this guy? He's basically consigned the next generation to the scrap heap of history.
And then finally on this, let's talk about number 11, because you talk about these young people having to compete on a global stage. Well, average household debt in the United States has now reached a level of 136% of average household income. In China, average household debt is only 17% of average household income. So there you go. that these Americans growing up who are saddled with student debts and now family debt, they're having to compete against these Chinese who not only have a better education system at this point, have less regulation at this point, have more freedom at this point, but they have less debt.
Well, we've seen the financial dictators at work in Madison, Wisconsin. The financial dictators go into the state assembly and they put their man in charge, the recent Republican political operative, and they say either you strip the community of their wages and their rights, or you are going to end up being prosecuted in some way, nefarious way, by the bankers themselves. So those people in Madison, Wisconsin now are being ushered into the gulag because of the financial dictators that are running riot in the country.
But also this odious debt burden on the young is also a great destroyer of innovation and entrepreneurship, of course, because it limits your options.
Well, let's contrast the experience of the United States of America and Iceland. They both went into the financial crisis. Iceland refused to pay the bankers' debts. The economy went into a depression for 2 years. Now they're growing again and they're coming out of it. The U.S. did the opposite. They mollycoddled the banks. They bailed out the banks. They left their population out to dry, and now they're still in a depression and they're not going to come out of it.
No. And you bring up Madison, Wisconsin, where the union members are being attacked by the Governor Walker. Now, this brings me to a next headline showing the decimation of the American middle class. The 401k generation is beginning to retire, and it isn't a pretty sight. Now, the important thing is this chart, and this is from the Wall Street Journal. You see there's a gap of $30,392 per year for Americans who are retiring on 401ks. And the gap is only $3,982 per year for those Americans who have pensions, i.e. workers who have rights are not suffering so badly as those who are, free, independent operators in the private market, where we were told in the 1980s when we were all put onto these 401k reservations that this was the answer to have independence and take control of your own future. Well, apparently it's not turned out so well.
Well, it's much worse, actually, because there's two underlying fundamental flaws in the assumptions. Number one, that the current 401k plans are estimating that they can achieve 4, 5, 6% return on passive investments like bond investments. That's now no longer possible and won't be possible as the economy in the globe continues to collapse. And number two, of course, this is all priced in U.S. dollars. As the U.S. dollar is collapsing, of course, the price of imports and the price of gas and energy, as we've been talking about, is going higher. So these retirement accounts, as bad as they are, it's much worse.
Yeah, and finally on that, they do recommend in the article that Americans are told to put 9% in their 401ks, but because the stock market collapse and the banker theft, that they're saying now, you should put 15%. Let us steal more of it. One way to protect yourself from these banking shenanigans, of course, is gold, and we referred to the global stage where we're having to compete against Chinese. A Chinese gold standard? ? China's grab for gold is accelerating at a rapid pace, and it's raising questions about the country's ultimate intentions. China consumed 175.2 tons of gold in the fourth quarter of 2010, bringing its grand total for the year to 579.5 tons. That's a lot of gold. The U.S. in comparison consumed only 233.3 tons.
Well, we know what their intentions are. The government has said they want to buy another 56,000 tons of gold. And that's why I think they're making these strategic investments in Europe, because they want to be paid back in gold bullion. Europe's got 11,000 tons of gold. And that's why they're buying things like GLD, which is the exchange-traded fund in the New York Stock Exchange. For large institutional players, you can take delivery in physical gold bullion, so it's another way to increase their gold position. Of course, they're going to go to a gold-backed currency. This will force other countries to do the same, but it'll first increase the capital flow into the Chinese economy while simultaneously devaluing against the dollar, because they do have less than there is in Fort Knox. So they hold all the cards over there in China. They're running the show.
But the propagandists here for the financial dictators are telling you, don't worry, Number one, first of all, the IMF, the capo de capo of these financial oligarchs, technically a full gold standard isn't an option for China, they say. Under the IMF's First Amendment to Article 4 of Agreement, ratified in 1978, participating countries are not allowed to peg their currency to gold. And then John Nadler from Kitco.com, the apologist for paper bugs, he also argues that China loves growth too much to switch to a gold standard. They would have to forget about 8% growth, he says.
Well, first of all, IMF people, listen to me, IMF. Pull closer into the screen. Let me explain. What about these two words don't you understand? Currency, war. What don't you understand about that? In other words, we're in a currency war. There is no law. There is no rule. It's the fog of currency war. China is not playing by the rules. They haven't been playing by the rules for 30 years. They're not going to start playing by your rules. That's ridiculous. And of course, this idea that a gold standard thwarts innovation is dead wrong. Of course, entrepreneurialism loves to have a barrier in which to entrepreneurially leap above. That's what makes the old saying that necessity is the mother of invention. When you have all of your engineers going from MIT and Stanford into Wall Street to create financial derivatives and to financially engineer new products, all that has resulted is a surfeit of trillions of dollars worth of paper and has stifled innovation. Paper currency stifles innovation. A gold-backed currency would increase innovation as it had done for hundreds of years leading up to the 1971 period when the world went on a pure paper fiat currency standard and you all had the relative valuations and the great fandango post-Nixon disco era of shimama, shawuwa, trading like you do on the disco floor. What's happening? I can't dance on this show? All right, continue.
Well, I might say finally, Max, that China is the world's biggest producer of fake goods. So if they're getting out of fake currencies and buying gold, I would say you should too.
All right, well, that's all the time we have for right now. Stacy Herbert, thanks again for being on the Keiser Report.
Thank you, Max.
All right, now, don't go away. When I come back, I'll be talking with a fella here on this show about gold and bonds, so don't go away. Hi, welcome back to the Keiser Report. Time now to go to London and speak with John Butler, founder of Amphora Capital and publisher of the Amphora Letter. John was previously head of index strategies for Deutsche Bank in London, and before that, he was managing director and head of interest rate strategy at Lehman Brothers in London. John Butler, welcome to the Keiser Report.
Thank you, Max.
All right, before I go any further, I want to jump right in here and address a big issue that's circulating around the blogosphere, principally from Mike Shedlock, otherwise known as Mish, very well-trafficked blog site. He says that the Fed cannot control the long rate. They can only control the short rate. But having seen your presentation in London recently, that's not true, is it? Talk to us about this.
Well, to be fair to Mish, I'm somewhat familiar with his arguments. And I think that it's important whenever you talk about something happening in financial markets that you have some concept of time horizon. And I think as a general rule, he qualifies that view by pointing out that they can do practically whatever they want in the short term, but in the long term, there's no way it can work. And so there's maybe a little bit of subtlety in the argument. But my version of this is that even in the short term, where people do accept perhaps central banks have more influence, that influence in longer maturities out the yield curve is in fact far stronger than most people think it is, in part because the lower interest rates become, the more long rates become correlated with short rates. And what I'm saying is that it's sort of taken for granted that the central bank sets interest rates at the short end, but as you move out the long end, they're set by the market. And under normal circumstances, I would argue that's true. But as you approach a zero interest rate, that is a floor below which interest rates cannot go, then mathematically, almost by definition, the link between short rates and long rates becomes stronger because you're approaching that zero bound. So the central bank, in fact, has far more influence over long rates in a very low interest rate environment, such as that we're in today.
I want to read you a quote from an investment advisor on Yahoo Finance warning people not to listen to gold bugs. Here's the quote. The precious metal asset class has no cash flow and no earnings. It's only worth what someone else says it's worth. How do you respond to this?
Well, I respond to it, first of all, with a bit of a chuckle. There are times when earnings are uncertain. There are times when cash flows are uncertain. And in fact, there are times when those earnings and cash flows are being determined almost entirely by the artificial monetary policies of central banks rather than being set by any reasonable free market in money. And the more manipulation, the more arbitrary policy you see being implemented around the world, the more unsustainable you believe it all is, the more you want to get away from those earnings. You want to get away from those cash flows. Why? Because they carry the risk of devaluation and default. If you don't want to take the risk of devaluation and default, you need to look elsewhere. Historically, gold is that elsewhere, as are certain other real assets. So people who are still looking at cash flow analysis, when the cash flows are basically being determined arbitrarily by a central bank, well, they need to really trust that that central bank knows what it's doing, and that it really is doing what it says it's doing, which is to preserve price stability. Are they really? Their historical track record isn't very good in that regard.
Let's look at China for a second. There's talk that China might introduce a gold standard. Your thoughts on this? And what about the argument that introducing a gold standard limits growth?
Okay, first of all, the China issue. There have been rumors going around for perhaps a year or two now that China was considering at some point pegging their currency to gold, moving on to some sort of gold standard. I certainly think that's possible, and if you consider it from China's point of view, I mean, they've really got a huge problem. You know, the old saying is, if you owe the bank a little bit of money, you have a problem. If you owe the bank a lot of money, the bank has the problem. Well, the United States owes China a lot of money, and naturally the United States therefore has an incentive to try and make it easier to service that debt. And of course, devaluing your currency is historically the way that countries go about doing that sort of thing. So China is very concerned. They would like to find some way of moving away from the dollar, but obviously there's not another major global currency which is an obvious replacement. You might say the euro could be a replacement, but the euro has issues right now with its own sovereign debt problems. So it's quite logical that China would at a minimum consider moving on to a gold standard. Whether they do it or not is up to them, obviously. The other point that you raise, I mean, you need to, when thinking about alternative investment generally, when thinking about gold and silver generally, I mean, historically, I mean, these were the primary stores of value. I'm sure China's not the only country thinking about moving in that direction.
Well, you know, this idea, the comment was, does introducing a gold standard limit growth? And this is something that you hear all the time. But, you know, innovation
but I mean,
yeah, let me just finish this. You know, the idea of having a gold standard, of course, would force entrepreneurs to innovate. And innovation creates jobs, and jobs create growth. What we've had in the last 10 or 15, 20 years is all the innovation, all the engineers have left MIT and Stanford and gone to Wall Street to create financial innovation, which has created lots of paper, and America's competitiveness has dropped like a stone. So you can't. That argument doesn't hold water. It doesn't even make any sense. So a gold standard wouldn't limit growth. In fact, it would foster growth. It would be the one thing that would create jobs and growth would be to make the rules fixed so that entrepreneurs knew what they were what game they were playing at. But let's move on to something that you've been talking about in a recent newsletter. John Butler. You say that developed world stock market valuations have reached levels normally associated with major asset bubbles. Okay, so forget about gold being in a bubble, because clearly we can talk about why it's not in a bubble. I want to talk about why stock markets are in a bubble. So let's talk a little bit about that, John Butler. Talk about stock markets and how they've reached stretched valuations.
Well, I think you simply have an inordinate amount of stimulus of various kinds that have been thrown at the global economy. And as I mentioned earlier, bond yields are in theory determined by the market, but in a very low interest rate environment, in fact, central banks have a lot more control over the whole yield curve, and they can bring yields down to levels which really just don't offer investors much in the way of an acceptable return. So not only do investors consider alternative assets such as gold, but they consider just equities. And indeed, some investors, they really aren't allowed to hold commodities in size. They really aren't allowed to move into gold. And so if you think bond yields are too low, well, then you're basically forced into the equity market. And so part of what's happening is that investors are throwing their hands up and they think, well, given this very difficult choice, this dilemma, we will hold equities because if we do get into an inflationary environment as a result of all this money printing, presumably equities will outperform bonds. If you look at historical periods of inflation, as a general rule, equities have outperformed bonds. Of course, those periods, however, can be temporary because at some point those valuations go so far that you get basically a feedback loop where people start piling into equities just because they're going up. You start getting bubble-like characteristics, and then of course eventually it collapses almost regardless of what the central bank does. It's starting to look a bit like that now.
Right, so what you're describing here is that the government and the Wall Street, and they've fused together now. It's really become neo-fascism in this way in the United States. They're able to corral investors into overpriced markets by offering nothing in terms of alternatives. So people go into the stock market looking for a 2 or 3% yield on a blue chip, quote unquote, S&P stock, and they're buying these at absolute stretched valuations, only to have the rug pulled out from underneath them once again, as we've happened so many times in the past. And you mentioned the dot-com bubble, and we don't see evidence of the dot-com bubble. However, we do see evidence of an incredible bubble in these unlisted dot-com-esque stocks like Facebook and Zynga. You know, Facebook getting a $50 billion valuation from Goldman Sachs. It's not a publicly traded company. It's a privately traded company. They broke the law in allowing more than the regulated number of people to invest in this. Of course, Goldman Sachs is above the law. They're doing God's work. But the valuations on those private companies are in the many tens of billions of dollars now. So we are seeing actually a stealth NASDAQ bubble. And what I'm hearing, John Butler, is you think that these valuations have reached the maximum point and would not be uncharacteristic for another big collapse coming for these stocks.
That could certainly happen, but we need to think in currency-adjusted terms. If the dollar itself collapses, I have no problem with U.S. stock market valuations going through the roof. So if you do get a serious pickup in inflation or, God forbid, hyperinflation occurring in the U.S. or elsewhere, the stock prices go up in nominal terms, but in real terms, in purchasing power terms, in wealth preservation terms, the stocks are overvalued here, in particular versus alternative assets which do not carry devaluation default risk, such as gold.
All right, so it's not an alternative asset. Gold's been the main asset for thousands of years. How have these guys been able to propagandize to such an extent as to make gold, quote, an alternative investment? How are they able to do that? How are the paper bugs able to push their agenda so successfully?
Well, people that generate fee income by originating risk, by selling paper into the market, and by trading it back, forth, and sideways once it's out there, these people naturally have an incentive to talk up financial assets and to talk down alternatives. You're absolutely right. For most of history, gold was hardly an alternative. It was front and center of the global monetary system. And even in day-to-day transactions, gold was used, although silver was more common for that purpose. So you're absolutely right. But the industry does have a huge incentive, a huge bias to tout paper forms of wealth because, after all, it's by creating that and trading that they get paid. We need to be very skeptical that there's an inherent conflict of interest between an institution that makes money by originating and selling paper and trading paper and their take on the relative attractiveness of paper versus something else.
All right, finally, we've got about less than a minute left. I just wanted to get your take on this idea, what was talked about recently at Davos, that the world needs to create a new $100 trillion lending facility to recapitalize and bail out the entire global economy. Of course, that would be 2 times the global GDP. That's $100 trillion in credit. Would something like this, the paper bugs, is this their last stand Is this that and basically, could it succeed, or is that just basically fanciful talk, and we shouldn't even take that as ever possibly going to succeed because it's completely nonsensical? John Butler.
Well, you can't put it past him. I mean, the fact is that history is littered with examples of policymakers doing increasingly desperate things when in fact those things are increasingly counterproductive. I think the evidence is increasingly clear when you see out of control food price inflation around the world to the extent that it's toppling one government after another. I think it's clear that throwing money at the problem isn't working. And for them to claim that just a little bit more money will somehow miraculously be enough is, well, to be honest, it sounds a bit pathological. It's as if these people are pathologically pursuing a policy of printing, as if it's somehow a panacea. Well, it's not. It's causing disasters in one country after another. They should have stopped throwing money at the problems a long time ago and started allowing economies to restructure naturally without artificial stimulus, both monetary and fiscal. They're digging themselves a deeper hole. The first thing to do is stop digging. It will be painful at first, but ultimately it will lay the foundation for getting out of that hole. Unfortunately, sadly, the incentive structure for politicians is in some ways as screwed up as that for modern financial institutions. And we just can't expect, when their conflict of interest is such that they want to remain in elected office, we just can't expect them to make the tough choices. We're going to have to do that for ourselves.
All right, it's not economics, it's pathological. I agree with you. John Butler, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, John Butler, CEO of Amphora Capital. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.